Recognize that these companies are not one company, meaning that they have a lot of different businesses. So obviously they're almost representative of the whole economy. They maybe don't have energy, but they've got most of everything else.
But here's the worrisome thing. If they are, as you say, representative of the whole economy, the whole stock market, what happens when they inevitably stop going ever higher and ever higher and ever higher?
Well, that's why we come to work every day. So right. I think the idea is, I think factually they're correct, right? Nobody's challenging those facts. So that's an interesting thing to look at and say, okay, what does that mean? And it tells you that the market they like earnings, right? They want earnings growth. There isn't a lot of it out there. And so they're gravitating toward this. It also tells you the power of the index funds, where they're buying these, as they get bigger in the indexes. And therefore, they have to be bought more. So as the money comes in, they just keep getting bought up.
Sure. And Kim, look, David makes a great point that people often criticize the market when they say, oh, they're way overpaying in these companies. Well, no, these companies have earnings growth. They're the only ones that showed it in the fourth quarter. So maybe it justifies continuing to pay up for them. I know you're not necessarily one to be a trend follower, but they've proven why they're such a lasting good investment, at least so far.
Sure. And I don't dispute any of it, but I would say each has a special situation. For example, Facebook and Google, they are taking over or taking market share from other advertising platforms, right? So that's just shifting money from one spend to another. So that's interesting, but it's showing you Wall Street rewards the winners. But if you're an investor, don't you want to pick the next winner as opposed to piling on in the current winners? Right. And that's the big question.
Where would you be? I'm going to jokingly call you Kim Intel Forrest. I know we know that's a favorite of yours, Kim. But where else would you do you think people should look for those next winners?
Well, I mean, always keep in mind, no doubt, that Wall Street rewards growth. So you have to look at what kind of situation could grow in the next, I don't know, whatever your time frame is, let's say 18 months to 3 years. And what is pretty clear is once we get through coronavirus and maybe a little bit more trade negotiations, that probably global growth is going to grow because of trade. So who's going to benefit? Yes, there's 5G and my friend Intel and the rest of that semiconductor area, but I also think that maybe consumer retail can come back in that because the pressure's off for tariffs. Mm-hmm. So I think looking in a bunch of different places for where growth can come is a really good idea.
David, same question to you, and also many times when we've asked the question, what could stop kind of the FANG trade, so to speak, from continuing, people will say, they're in a way trading off what's happening in the bond market. And that if you did have suddenly, move, I'm not sure I totally buy this argument, but that a substantial move higher in bond yields would kind of change the attractiveness in terms of where you'd want to be in the market. Do you see something like that happening?
Well, I think
as these yields and look, they are the lower we go in the 10-year, it is going in tandem with these moves higher in those stocks.
Well, certainly that's been the trade for a number of years now, and I think the Fed is basically taken away a lot of the volatility, and they don't want volatility. The market loves volatility because they can, Wall Street loves that, and but at the end of the day, without the volatility, the winners are going to keep being the winners because they have the capital, they have access to Wall Street, they have access to the best people and the best ideas, and they're going to continue to consolidate around that. So I think it's, unless you get volatility in the capital markets where capitalism comes back, where they let price discovery happen, it's going to be very hard for new entrants to come in.
I mean, that's a pretty big statement.
Well, again, the Fed is taking it away by using their balance sheet. We had a 30-year bull market in bonds engineered by the Fed, which helped a lot of people. Now we're having rates that are so low, and the Fed doesn't want to take their foot off the boot of low rates because they realize if they do that and there's a recession, it's their fault.